You were talking about the year you just had in 2015.
So most spins ever, greatest amount of deal volume in terms of M&A ever. IPOs were down significantly. In fact, if you look at the number of IPOs overall, not just tech, which is what your original question was about, it was the fewest number of IPOs in a decade, excepting the height of the financial crisis, 08, 09. Similar with tech. So in other words, tech wasn't unique. Tech kind of followed the overall market. Investors focused on improving their own portfolio. They weren't looking to add new deals. However, when I look at the tech deals in particular that were done, and the marquee deals, you think of as Square, Fitbit, GoDaddy, Shopify, these really great companies, they're doing really well. And that's not the story that you hear. I mean, each of those companies is trading 40% up in the aftermarket, or pardon me, 35% up in the aftermarket or greater. So I don't think the message from this year is, hey, we're not going to see these unicorns able to go public in 2016. I think the message was investors were focused on something different. Are they going to pivot their attention to, okay, now we're ready to add to our portfolio? And if so, there'll be the ability for good companies to go public.
Yeah, but it's not necessarily that investors are saying, I don't want to buy a new deal. They weren't being offered them. If they could get into Uber, they would.
Well, to some extent they were. I'll come back to Uber in a second, but there were over 20 IPOs, including marquee IPOs, that were announced to go in the second half of the year that just didn't, and including many went on the roadshow and actually went to investors, and investors said, you know what? We have enough we're worried about. We're worried about China. Is the federal government going to be able to fund itself? That's
a great point. I think we forget that.
Tom, go back to Stephanie's question, because I don't know the answer to it. We interviewed, for example, the CEO of Airbnb.
Brian
and
Chesky.
Specifically said, do you want to go public? And he said, not anytime soon. We have enough money.
Tory Burch, same thing.
Tory Burch, the same thing. We hear that from a number of CEOs of successful companies who say, we have enough money, we've got it from VCs, we've got it from other sources. Is that a new phenomenon?
I actually think it's turning a bit. I've heard that now for a couple years. And when I show up and I meet with a company, and let's say it's a tech unicorn, it sounds kind of funny coming from me. Hey, you should go public, because they just assume I'm biased on the New York Stock Exchange. So I kind of kept it to myself. But now other voices, like Mark Benioff has come out recently, are saying, hey, if you're a tech unicorn, there's actually a lot of benefit to going public. You have a public currency. You can do acquisitions. You have the ability to raise dough in a new way that you didn't have previously. You have the credibility that goes along with being public. Airbnb and Uber, just to address them differently, and one or two or maybe three other companies, they're in a class by themselves. They have credibility. Private markets are flush with cash for them. They have the ability to do acquisitions. So you kind of have to put them in a different conversation from the other 130 tech unicorns. And I actually think the mindset is changing to, it probably does make sense to go public if possible.
It's also the only way to monetize. If you're an early investor in one of these companies, how are you going to get your money out?
Well, there are secondary markets where you can do that, which is an interesting phenomenon in itself. But do you think that part of the problem why some companies don't want to go public is maybe the IPO process itself is broken? I mean, yes, Fitbit has had a great go at it, but for every Fitbit, there's kind of like a GoPro, and I know that's not a New York Stock Exchange company, or there's a lending club where their charts kind of look like Mount Everest. They go way up and then they go way down, even though the companies are performing very well. Do you think there might be something actually inherently broken in the IPO process, the way IPOs are bought, marketed, and sold, that might get people to say, CEOs to say, you know what, I'm not sure I want to do that?
The valuation, the valuations that you just described, really, in the first half of last year were quite high for technology companies. That was mirrored in the private markets. If anything, it was exaggerated in the private markets. And a year ago, we were saying, wow, these companies are getting private market valuations north of where they would get in the public market. What I think we've seen is that these good companies, take a Square, for instance. These good companies, they're fairly valued. It's a company that's raised round about $1.5 billion of capital. It's worth round about $4 billion of capital now. In a very short time, they've created $2.5 billion of value. But perhaps those investors who went into a Square or take another company a year ago, they're not making as much money as they had hoped. But the Series A investors, Series B investors, and now the public market investors, they're all doing quite well. So I do think...
Tom, can I
Please.
That abruptly, but I'm looking at 12 years of IPOs here, and there's a great function on the Bloomberg IPO GO. You can search through by sector, by year, by market, whatever. But obviously the big dip in 2008, 2009 financial crisis, right after we popped up, a little bit of lull, popped up again, and now are we headed down into 2016, do you think, for another lull year? or do you have plans? Does your team tell you that this is going to go back up?
Matt, is that by number or value?
This is by number.
By number, okay.
Quarterly.
You know, I have to answer your question with a question because it depends on what you think volatility in the market is going to look like. You know, the relationship between volatility in the market and the number of IPOs has inverse correlation of nearly 1. So if volatility is going to continue to be heightened, which really started in late August of this year and has continued, then we'll have another slow year for IPOs next year. To the extent the volatility calms down, and given that we have more certainty about what the Fed's going to do and the federal budget and oil exports, one could come up with a theory or prognostication volatility will reduce, then I would expect volatility IPOs to be back on the previous trend
line. Isn't it also
line.
a function of the private market? I mean, if they can get the capital they need from the private market sources, they don't necessarily need to go public. But if the public market becomes the only source of viable capital, then quickly I think people would turn to that market, wouldn't they?
Absolutely. What I'm hearing from people who are in the private market day in, day out, whether it's bankers, VCs, or some of those public market investors who are investing in private deals, is that market has greatly reduced. The spigot has been turned off, and private financing, in particular in the technology markets, has dried up dramatically.